Good morning, everyone. Mike and Corey here today. We're going to talk about some exciting things. We're going to talk about the Consumer Electronics Show that I attended last week in Las Vegas. And we're going to talk about, as far as the jobs report that came out last Friday, which was good news for the world or good news for the United States, but maybe not such good news for getting future Fed rate cuts really soon. And then Corey's going to dive into the 10-year bond and how it's reacting with all of this. But before I get started, must remind you this is a financial education presentation. You must do your own due diligence on anything that you hear in this presentation. More disclaimer information can be found on ankerstarwealth.com, and the opinions expressed are mine and Corey's alone. So before I share my screen, I'll just say, boy, it was a week to be out. I was in Las Vegas seeing they had, I think, 4,500 exhibits. I did not see them all. And 180,000 or 181,000 attendees. It seemed like it. There was a lot of people, and I could see that CES badge everywhere that I went. People in line to see these different exhibits. Corey, it was exciting. We got to hear incredible presentations by Jensen Huang from NVIDIA, from the CEO of Delta, who brought on, it was almost like bringing on his friends, brought in the CEO of Uber and another company called Joby, which is like small flights. And and even closed out with Lenny Kravitz on that one. But when you go to something like this, it's really looking at the future. All these exhibits are trying to say, hey, we've got a great idea. Now maybe Delta and Uber, they're already at NVIDIA, they're already established. But there was lots of companies from lots of countries around the world saying, hey, we've got this great idea. And here's how it works, and here's the brochures, and let's get your information. So I know that myself and my son walked around a lot. Steve was there as well, but to see these exhibits, and it got me really excited. So what I did is I went out and I found where CNET had reviewed the top items they saw, and I figured I'd show those since it was already prepared, and I agree with these. So I'm going to share my screen, and you can see some of the coolest tech products coming. And I guess when I think of this, I just think of innovation. And someone might say, so why are you guys there? Well, we're looking for innovative ideas to invest in so that we at Ankerstar Wealth can become owners. Obviously, we have to make sure they're viable and that this company is going to grow. And I will say that there's lots of competition. So like when I looked at, virtual reality glasses, or even like in-home golfing setups, there's competition there. We saw 3 or 4 of each. So here was some of the items that CNET called out. Now, I'll probably go real quick past as far as NVIDIA and their chips. I mean, I think people hear about that, and NVIDIA is already one of our core holdings that we have. So I'm not gonna spend much time. I'm gonna show you some of the cool stuff that they came out that you might not have heard. How about this? A quadcopter. How would you like to be able to have your own 2-person EV flying machine? That might not be right around the corner, but maybe someday. I mean, some of these are very far out, but then other ones are not. Here, another one, satellite texting from any phone. And as I sat on a Frontier flight flying back and could not see the score of the Ohio State Texas game until I landed and saw that Ohio State won, I'm thinking satellite texting anywhere would be great. This one, hands-off AI laundry. Corey, do you think you might like that?
What's the use case there? Is it mobile laundry or
laundry? Read the header. Laundry is too often daunting. You just need a small set of laundry. Let the robot do it for you. Maybe not. Maybe with 2 kids, you need the bigger size one, right?
We go through quite a bit. We really do.
A battery made of paper. I want to get down to this one. Here we go. humanoid robots with AI augmented conversational skills. So, we've seen the movies with this all the time, and now this one was a semi-realistic looking person, but I know that my son and I also saw one where the robot had vision, and it would roll up to us. It did not look like this person here. Um, I would shake its hand, hand it a document, and it would pick it up and like look at the document and then hand it back to me. It just made me think how close we are to having robots and humanoids interact with us. Now, this one, how it works or how the one I saw works, not sure yet, but I just think 10 years from now, that could be a lot more realistic. And then I think there was one other one I was going to share here. Big TVs, we know all that. Right here, an air purifying cat perch. Now, what made me think of this is, what can AI replace? Now, this one is making a nice thing for your animal. But what I also saw is there was AI animals that you could like wave your hand to and it would come to you. You could pet it and it would jump around, and it was an AI animal. And it would actually could distinguish between different people. So it might say, this person's my owner and this person is someone I've never seen before, and I'm going to act differently. So you never thought your pet could be replaced, but guess what? Maybe someday it will be. Now, I'm not saying it's the same thing, but it kind of acted the same. So, anyways, just some of the ideas that we saw. Also saw like a window cleaner that you hook, an AI window cleaner you hook on the back of your house, and it would clean your windows and move from place to place looking for dirty spots. Same with one that does your pool, beyond the little pool thing that cleans the bottom of your pool. This one would clean the sides. Another one that Spencer and I were looking at was an AI dartboard, so you could play darts at your house against your friend that lived in a different country, and you could see each other's results and interact. So a lot of things out there as far as the future with AI. I will say this would be, and I mentioned this, Corey, earlier, my only concern with all of this is there's a lot of distraction too. I mean, some things I like, oh, this is a productive tool, could make your job go better, more efficiently. But then a lot of them, like, this could just distract you to do nothing. I mean, I'll take the sports gaming side, which we know there's gambling out there. There was so much information on gaming and gambling, and I mean, I was in Las Vegas, so that doesn't surprise me. But I mean, there was so much that it could just be overwhelm you to you could just put all your time into that. So that would be my downside to it. But as far as the future, we'll see which of these companies come out and turn into the next whatever Palantir, I'll say. So, Corey, what do you think? You ready for an air
I'm ready to
purifying?
get in my quadcopter with my AI cat and throw some darts, man. I'm ready. You know,
Yeah, I
I
mean,
I honestly I almost dropped a can of beans on my toe leaving the grocery store yesterday. So I don't know if I'm ready for all that. Maybe I'm one generation behind all that.
I don't know, Corey. You're one generation closer to it than me, that's for sure. But and I had mentioned to Corey that if you have not seen the movie Ready Player One, which is set in the 2040s, which is only 15 to 20 years away, if you have not seen that in the future, I don't know. I feel like we're moving towards it. It's like uh, you see a online virtual world that can take over and become your life. Is it productive? That's my biggest concern is like if everyone's just going to sit around and play on their computers. I'm not sure where this whole world's going to go. And a lot of this lends itself to sit around and playing on your computers. Even the AR, VR type glasses. Hey, if you can have a virtual meeting and have, as far as good conversation and verbal cues, visual cues with a person, that's great. Makes your meeting go better. But if you're just going to sit around and watch movies and play games, I don't know about that. But and obviously everything done in moderation is fine. So let me move on to back to the real world. Back to the, I got to go back 10 years into the real world now. And real quick, I'll just look at the stock market today. We can see and I'm not going to worry about the Dow, but the S&P's down 0.7% and the Nasdaq's off 1.4%. And I know there was a little bit of a sell-off last Friday, which I'm going to touch on here in just a second. The markets so far in January are down, which is, I don't want to say concerning, but considering how much the markets have been up the last 2 years in a row, it's not necessarily surprising. We'll see where it goes, but the real key is what's causing them to be down. Is the United States economy falling apart? Is inflation raging higher? Is the unemployment rate raging higher that we could be going into a recession? No, no, and no. Is there any geopolitical event that's causing the markets to go down? No, not right now. So what is causing them to go down? And I'm gonna flip over to the jobs report, because when I saw this come out Friday, I was like, oh, that's great news. The United States payroll is, we're getting more jobs in the United States than they expected, and the unemployment rate dropped to 4.1%. As a United States citizen and a person who wants productive employment in this country, this is good news. So why did the market sell off a little bit? I don't want to say it's a big sell-off, but why did the market go down? Because what the market is expecting is the Fed to cut the funds rate. Originally it was, I don't even know, 4 or 5 times this year. And now when you see good news like this, that means the economy is doing well. The Fed does not need to pump it and give it cheaper money. And so now the chance of these rate cuts is going down to maybe only twice this year. And therefore, companies, people that value companies and do the estimates, they're going, wow, money is going to be more expensive. It's not as cheap to borrow it to fund future, endeavors for each company. And therefore, the company sold off. And this is one of those when good news is bad news for the stock market. Good news in the economy is bad news. But I mean, part of me steps back and says, wow, the Fed accomplished a soft landing. Inflation is under control as of right now. We're still seeing it continue to decline. Unemployment, those are the two mandates of the Fed, the inflation rate and unemployment. Unemployment is not going up. It's down to 4.1%. Oh, that's good news. I mean, if our country's not going into a recession, that's good news. When will the market reflect it? And that's what we'll get into this year as far as how this will play out. If the country was going into a recession, I'd be like, oh, well, I mean, that's more concerning, but seems like good news. And what that leads into, it'll lead into Corey's topic, which is the 10-year bond. So, whether the, I don't know, concerns of Trump's policies cause inflation, which, that could be caused by either tariffs being put in, or not just used as threats, which I feel like they're more used as threats, or and one of the things that came out of the jobs report last week is wage growth went up by, I think it was 3.8% or something like that. Oh, 3.9%. It's on the screen there, which was below the outlook. But if there was a mass deportation and lots of people were thrown out of this country, therefore there's less workers, therefore you must pay them more, that would cause inflation. That's some of the concern. So with that, Corey, I'll flip it over to you. You can talk about the 10-year bond and how it's reacting.
Yeah, you're right, Mike. That some of that the concerns around potential increase in inflation is really on investors' minds. It's really something to watch. And this week we do get CPI and PPI, and we'll want to. That will be our next data point to kind of give us insight into, is that inflation trending back higher a bit, or is it kind of just moderating at a little higher level? So I think hopefully we get that it's moderating at a little higher level than the Fed wants, but not really in a place where it's increasing. Okay, so jumping over to, yeah, this has been on people's mind as well. This has been putting pressure on a few different parts of the stock market. Um, really for the first time, I mean, if we go back here, to let's start at like the GFC in '08. Ever since then, bonds, especially longer duration bonds, haven't really given investors anything to use. So investors were forced into equities for at least that decade from 2010 to 2020. And there was this whole theory about bond proxies and essentially companies that traded like bonds. They had very stable business models, but had a higher yield than the 10-year rate. So it would give investors a little bit better income form of return without bonds, because bonds weren't really an option. And we can see today, tiny bit of upward pressure, but really it's been, over this past month, you've seen quite a large increase there. Okay, so why is the 10-year increasing at the same time as the Fed has actually done 4 rate cuts? I think we've seen over 100 basis points of increase on the 10-year at the same time as the Fed, pushed through 100 basis points of decrease on their short-term rate. So Jurien Timmer, I think head of research at Fidelity, I might have missed his title, but he is that for Fidelity. He is making sure people know that we don't have an increase of inflation expectations yet. This increase is coming from an increase in term premium. So prior to the great financial crisis, term premium was the norm for longer duration rates. You'd get a little bit of premium for that longer duration as an investor, taking the risk of that longer duration commitment there. But that was that unusual pattern. So we got the unusual pattern of actually a negative term premium after the great financial crisis, and up until the past couple of months. So he's thinking that if we do get a reversion to the mean there, or a return to normal, we should get somewhere around 150 basis points above that short-term rate for these longer duration, for the 10-year. So if that were to come to fruition, while the Fed does not push through more decreases or rate cuts, then he's essentially predicting here that 10-year is going to get up in the high fives, and where it could moderate around 5.8, 5.7, somewhere in that area. Again, that's if things stay constant, and that's if Jurien is correct. So provides great research. It's something to watch. If we do see the 10-year pop above 5, I do think, at least for the time being, 5.7, 5.8 would be a somewhat reasonable stopping point. Now, that does bring us into a little different scenario than what we've become accustomed to. Hold on, I guess I timed out on this screen. So since the early 80s, we've been in a very clearly defined downtrend in rates. It's been a multi-decade downtrend in rates. Well, there's speculation that, as opposed to moderating at 0% or just above 0%, we have now started a multi-decade uptrend in rates. That's a theory that's out there. If that is the case, that would price in. So let's play through these couple of decades here. In the 80s, in the 2000s, and even in 2020, when we had a recession, the response was drop rates, bonds go up, and stocks, go down because of the recession. Well, if we go back prior to the 80s, the economy in the 1950s, amazing. 1960s, amazing. The stock market returns were amazing. But when things are amazing for a very long time, maybe the government is increasing debt. I don't know debt to GDP levels in the 60s, 50s, and 60s, so I cannot recall that off the top of my head. But that can lead to a period of the market being too hot and maybe creating some inflation. And that's what we got in the 70s, and that wasn't handled well. So we had a multi-decade uptrend in rates, which put a lot of pressure on stocks. And then, the multi-decade downtrend was a tailwind for stocks. So if we're in a multi-decade uptrend just now starting, we just want to be mindful of what that means. So let's go to college just for a second. I won't spend long here, but stocks are considered risk assets. And of course, they're not guaranteed. Returns are not guaranteed. Even dividends are not totally guaranteed, even though, for many United States companies, it's a very stable, reliable thing, but not guaranteed. So in the capital asset pricing model, risk assets are priced as a function of the risk-free rate of return that investors can seek elsewhere. Well, in the 2010s, the risk-free rate was so low that it did give a better premium to risk assets. And as that risk-free rate increases, so if we get that 10-year at 5, 6, 7, 8%, I don't think we're going there, but just be something to keep in mind. It does push stock valuations down. It puts downward pressure on those valuations, particularly on those bond proxy type assets, like a Pepsi. If Pepsi was falling as hard as anything last week, like a crazy speculative stock, right? Because so let's go back here. In the 1970s, Pepsi's valuation was forced down to, as rates were increasing, it was trading at like 0.5 sales. And it was trading like dirt because it's not going to give you a better return than a 6.5% risk-free rate. Now, eventually, things go too far, and that moderates. But just wanted to share a few things around where might the 10-year go? What does that mean? And that's some of the things we're watching.
Yeah, and I'd say the biggest thing it really means, a huge thing is the housing market, because the 10-year bond is really what the mortgage rates. Anytime I was financing or refinancing a house, I was watching the 10-year bond. I was looking for dips in the 10-year bond. With it going up, that means the interest rates for a 30-year or 15-year mortgage are going up. So that's to me is the biggest concern. I know there's a lot of the population is sitting on their 3% mortgage and not looking to sell, because if they sell and buy something else, now they got to finance into a 7% mortgage or whatever, 6.5, something like that. So that is the concern, and that inventory of houses is just, it's not increasing because people are not selling. And I personally agree with that. I wouldn't want to go sell and go get myself a 7% mortgage. So it's tough. And I know that initially back in September, when we saw the Fed make the first 50 basis point cut, the 10-year bond went down, and there was some refinancing. It had come off the highs, and I personally would have been tempted to say, well, it's going to keep on going down because the Fed's going to keep cutting rates. And what's happened is it's, went back up again. And certainly a concern if you are looking to refinance your house or buy a house, that is the concern. So we will monitor that.
Also,
Yeah, go ahead, Corey.
also, there are some benefits as well. If we do get that 10-year moderating in the high fives, that gives those fixed income investors opportunities that they haven't seen in a long time, those lower risk fixed income investors. So that'd be very good for them. They're holding bonds now. It's not as good, but it gives a rotation potential later on. And then if inflation doesn't heat up from here, equity valuations should be okay as they are. It would really be if you get in those, if inflation comes all the way back and the Fed has to go, that's the pain scenario. But everything else that's going on is normal. The market's just trying to figure out where that term premium ends up.
Awesome. Okay, thank you all. We'll be coming out to you later this week, talk about the CPI, Consumer Price Index, and how that affects inflation, PPI as well. So thanks, everybody. Have a good one. Bye.